Happy Friday, everyone, and welcome back to Your Finance TV. As you always know by now, Fridays are with Jay Pelosky. We are so excited on Fridays to have Jay with us. How are you, Jay?
I'm good, Scott. How about you?
I'm fantastic. Looking forward to a long weekend, Father's Day, which I'm sure you are as well.
Absolutely. And yes, Juneteenth. So lots to celebrate. Absolutely.
All right. Before we jump into the show, don't forget to click on the like and subscribe button below. The numbers keep growing. We're over two and a half thousand subscribers now, and we only started a few months ago, so that's great. All right, let's get into this. The title for Jay's musings this week are "What a Difference a Year Makes," and it's a big understatement, really. Like when you think where the market was 12 months ago to today, wow. And Jay, like you haven't been sitting on the bearish side, have you?
No, thankfully, we've not been because over that last year, I just ran the numbers. Global equities are up about 15%. Barclays Ag, so broad fixed income is down several percent. And commodities, represented by the Goldman Sachs Commodity Index, are down 20%. So it's really been quite a sharp divide between the three main asset classes, that we look at as global macro investors. And that was really the idea, Scott, was right. I have to admit, first off, that the title is not mine. I took it from the bespoke research people who used it earlier this week. And I thought to myself, that's perfect. And it reminds us that we are competing as investors or advisors with a forward looking discounting machine that incorporates all the thinking of all its participants, the global financial markets, right? So talk about AI, that's HI, human intelligence. And so it's really a battle to stay focused forward, and particularly in the environment we've had, I think, the last several years. So let's look back, and then we'll look where we are today, and then we can go forward and see what we can learn. So a year ago, May CPI number just come out. It was 0.8%. It was way higher than expected. That led to inflation expectations blowing out. It spooked the Fed. This was the beginning where the Fed went into 4 75 basis point rate hikes in a row, something 75 basis point hikes had barely been seen in the prior 20 or 30 years. Investors were bearish. Stocks, bonds, commodities were weak, and cross-asset volatility was rising, as were calls for recession. So that was literally in June of 2022. Now looking where we are today, inflation is falling almost as quickly as it rose. People talk about sticky and not falling fast enough, but Credit Suisse had some good work out this week that pointed out the 2-month decline in May and June inflation, 2023, May and June inflation, is among the fastest 2-month declines in inflation that we've seen in over 70 years. Inflation expectations back to 2-year lows. The Fed gone from raising 75 to, as we saw a couple of days ago, on hold, and investors are bullish. We talked about what the markets have done over that time period. And even today, right, this week, ACWI is going to be up about 3%, the best week for global equities in over 3 months. The return to stability that we wrote about in our 2023 outlook, published back in October, actually, of 2022, stability ahead. That was literally our title. And we're in that. We're now here 6 months, 7 months later, right? The VIX a year ago was over 33. Today it's under 15. The MOVE index for US Treasuries a year ago was 138. Today, 107. So we're in this middle path that, again, you and I have talked about for months and months and months, again, going back to last year, the middle path that we thought we were going to be on, and we are on, between high inflation and deep recession, clearly moving in that direction. And the Fed has even now kind of cottoned on to this, as it has to the high nominal growth world. That's been a big key for us because of what we thought it would do for earnings, namely keep them more robust than many expected. Because people like to knock nominal growth, right? Because they want to focus on real inflation adjusted growth. But let's remember the key lesson, one of them of the past year has to be to remember that earnings and sales are priced in nominal currency. So you have to be very careful not to confuse inflation and real earnings growth, because the market focuses on the former, not the latter.
Well, let's move out from the past, right? Like, there's probably a lot of bears sitting back there who don't want to look at the past. Let's move to like the present. And listen, the big focus this week, and you touched on it there before, was the Fed. It was all everyone was talking about. Most people expected to be no change, like yourself. Like, what did you think of the Fed's comments this week?
Yep, I think that's absolutely right. That is the main item, because I think it guides us forward. And yes, we were and have been in the camp for some time. The Fed was going to pause. We think it's more than a pause. We're in the Fed is done category, mainly because next June's inflation, as we just touched on, is going to be significantly lower. A year ago, June of 2022, inflation came in at 1.2%. This June 2023, expectations are for 0.3, 0.4% inflation growth. And so the year-over-year numbers are going to drop under 4% when this data point is reported. And like this month, the CPI data comes out before the July Fed meeting. So we don't see really any likelihood at all that the Fed is going to hike rates in July, even though the market is still pricing in like a 65% probability of that happening. But, really what was important to us is the updating of the economic forecast, right? We've been pointing to this for several months, that the real key was not the Fed going on hold, but the updating and increasing of its growth outlook. And the Fed delivered exactly that. So if you look at the new forecast for GDP growth in 2023, the Fed more than doubled it to 1%. If you look at the inflation forecast for 2023, roughly unchanged at around 4%. They give you several different variations, but effectively they're around 4% for the full year. And importantly to us, we take that 1% real growth, add that 4% inflation, and come up with 5% nominal growth for 2023. And that is a sharp contrast to the nominal growth path that was in place pre-COVID, where growth was about 1.5%, inflation was 1.5%, give or take. And so your nominal growth path was about 3% versus 5% for 2023. And by the way, the Fed is not alone. The ECB, which raised rates yesterday and probably has a little bit more to do, also updated their forecasts with the same outcome, namely a nominal growth path of about 4% this year and next for Europe. And Europe's nominal growth path pre-COVID was even less than the US, was about 1.5% to 2%. So our point is that we're not going back to the pre-COVID low inflation, low growth world, but rather we're moving into a high nominal growth world where nominal growth will be double or more what it was pre-COVID. And that's going to be driven by all the things that we've been talking about over the last several months. The new industrial policy, the central banks kind of validating that high nominal growth path, as the ECB and the Fed have just done, in our opinion, and the opportunity for enhanced productivity that comes out of the AI innovation cycle. So we continue to feel quite strongly that the growth outlook over the next couple of years is considerably better as the US, Europe, China, the entire world focuses on dealing with the 3 C's of COVID, climate, and conflict.
You sort of jumped to I was going to lead into like what you see going ahead there, and you've touched on a lot of those there at the end because you're supposed to stick with the present on that one. But
Anyway. The present's okay, but the future's even better.
Well, it is. Listen, those prospects, some prospects are looking good going ahead. Like there's like there might be a couple other areas you want to touch on there, what you do see going ahead. But what I'm really looking for here is like some words of wisdom, and it probably rings true with Father's Day coming up. Like you're a father, I'm a father. Like, what are some of the like things that you should be looking for, and like some good points of interest you should be telling to the viewers today?
Well, I think you're right. I did kind of move into the focus forward segment of our talk because I do think it is quite appealing. But let's take a little bit of a step back and talk about, where rates are likely to be over the next year. We're in the higher for longer camp. So we do agree that with Fed funds rate future pricing of around 5.1% at the end of this year, and we note that the bond market has moved in that direction, right? Taking out all the rate cuts it had priced in over the last several months. That to us is the bond market telling us no recession, right? Now we have the Fed doubling its 2023 growth forecast, also saying no recession. And so to us, we pay very little attention to the dot plot, right? People are focusing on the dot plot and the idea that the Fed is expected to raise rates 2 more times before the end of the year. That the dot plot has no predictive power whatsoever, and so we pretty much dismiss that altogether. What we're focused on is the realization that housing has bottomed in the U.S., that the inventory destocking, which really lowered growth in the second half of last year, is likewise finished. And there was a great data point in the Wall Street Journal this morning noting that rail car loads of motor vehicles and auto parts in May were up 15% year over year, and had the largest, highest average weekly carload volume in 3 years. So that's the kind of data point that tells us that the destocking, right, when cars were running off the lots because they couldn't get the chips to produce new cars, right? That destocking is over. The chips are now available. Car producers are in fact producing cars. Shipments are up 15% year over year, the best in 3 years. And so that tells us that the manufacturing sector is going to catch up to the services when you think about PMI, services and manufacturing, right? Services have been strong. Manufacturing's been weak, under 50. We expect that destocking to shift to restocking to build up that manufacturing level. And we just know that, again, the market is forward-looking. So transports, U.S. transports, IYT, is up almost 10% over the past month. The market is sniffing out an economic recovery. And so we remain guided by the mantra that, again, we've had for some time. Fed on hold equals U.S. dollar weakness, which equals rest of the world outperformance, commodity opportunity, thematics opportunity. And we're really looking for, in this space, a new rate cycle to start a global rate cycle to start in the next couple of months, namely a rate cutting cycle. Now, importantly, the PBOC in China has already started, right? Made some noise this week, cutting interest rates. Let's keep in mind that China has no inflation problem. Their inflation rate is about 1.5%. They have plenty of room to cut rates should they so desire. They're trying to stimulate domestic demand. We think that's going to manifest over the second half of the year. So there's your second biggest economy in the world, desynchronized, leading the way, cutting rates. We think other central banks in EM, particularly in Latin America, are going to follow. Brazil, Mexico, Chile. We expect all of them to be cutting rates in the next couple of months. And so one of the big differences we see as we look forward is we're shifting from a global rate tightening cycle to an easing cycle. And that easing cycle is going to be led by emerging market central banks.
There's one last little point you had in your musings. Oh, not last point, but one. It's in mentioning the Barron's new bull cover. It was quite interesting because we've done quite a few videos with Matt Tuttle, and in his daily email, he came out saying, usually you see though you never see those at the bottom of a market. You usually see them towards the top of a market. Obviously, a little bit of difference, and Tuttle's a little bit more liquid than you are. Like, not liquid's not the right word, but he moves around a bit quicker. But what do you think about that? Like, usually when I see signs they're putting out covers like that, I'm like, oh, hang on, that's a little bit concerning. But you think we've still got legs here, right?
Well, I mean, it does go back to the point that, again, we've made for a couple of years, the speed and how things are kind of discounted and priced in and thought about, right? I mean, things move much, much faster than they used to. And so I think this is another example. We just barely have, many people don't agree with the idea that we're in a new bull market. If you accept the October low to current levels, and yes, we've gone up 20%. Yes, that in some instances or some folks' minds is a new bull market. And yes, when you see bull market covers on Barron's or The Economist is one that I like to pay attention to because they have a long history of top ticking things with their covers. So let's keep an eye out for The Economist having a bull market cover. But so far, no on that front. But yeah, actually, our parting words of advice in this week's musing is to, if you've been patient, as we have been, right? We wrote a piece a month or so ago. It's titled Patience. And we wrote a piece soon thereafter titled Rotation, right? Arguing that we were going to rotate from the big tech leadership to cyclical leadership. We talked about transports. We've talked before about home builders, et cetera, et cetera. That is happening. So if you've been patient, and if you've been bullish, as we have been, and accused of being Pollyannish and many other words that we can't share on a network such as YourFinanceTV, we absolutely do not recommend selling here, right? We are at the beginning of what we think is going to be a multi-year period of high nominal growth driven by a global CapEx cycle to deal with the 3 C's of COVID, climate, and conflict, in a cycle that is going to be enhanced by the productivity unleashed by the AI innovation cycle. Our analog continues to be the second half of the 90s, where you had higher rates for longer, you had enhanced productivity from all the internet coming on board, and you had a nice run of pretty decent global equity performance for several years. Look, the B of A fund manager survey out this week pointed out that investors have 3-year low positions in commodities, okay? Commodity positioning in their survey is at a 3-year low. So commodities are certainly not overbought. We note that in the same survey that investment grade holdings versus high yield are at an 8-year high. Okay, so that is certainly not bullish sentiment. And by the way, we're overweight in our global multi-asset model here at TPW, overweight both commodities and U.S. high yield. So we think there is a lot of room to go in the commodity space, in the thematic space, in emerging markets, in non-U.S. equities, and in cyclicals in the United States. So rather than getting off the train at this point, we think one should be patient, look for opportunities to rotate. I just laid out a half a dozen spaces where people can look for opportunities, and reach out to TPW Advisory. We're here to help.
And where can they find you? Is it Pelosky.com? Is that the one?
That is at Pelosky.com, yes.
It's interesting you mentioned the home builders. I was just looking on the side there because Lennar had their numbers this week, which we covered earlier in this week with Brendan from Column E. And he liked the stock, and like the stock's at all-time highs again now. Like the momentum's there with the home builders.
Yeah. So, and people are talking about a housing crash and like how bad the housing market is. And housing stocks are going out at all-time highs.
Yeah.
XHB is right around a 52-week high. We've happily had it in the portfolio since the turn of the year. We have about a 4% position in our global multi-asset model in XHB. So, we've been there and we continue to be there. But, today, we think there are other opportunities more interesting in other parts of the world, as we just laid out. But holding on to things like XHB in this environment, to us, makes an awful lot of sense. So the other thing I would just mention is that this turn, Scott, in sentiment has been so aggressive and so quick that I definitely struggle to think that all that cash, which had built up on the sidelines, right? That's $6 trillion in money market funds. FactSet reported, in fact, that year-to-date cash inflows to ETFs, all ETFs, so fixed income, equity, et cetera, are running at 4-year lows, okay? That's FactSet, 4-year lows. So the way I think about it is any pullback here, and there will be a pullback, and a pullback actually, is healthy at this point because some parts of the market are certainly overbought. But any pullback is going to be met with buying interest because there's just so many people so far behind on their benchmark that I think the risk of a big downside move is very, very limited.
Jay, have a great Father's Day, and thank you so much for your insights today.
Great, Scott. Likewise. Same to you, buddy.
For everyone else out there, good luck investing.